Can you pay yourself a dividend? This is a common question for limited company owners, especially when there's money in the company bank account. In this video then I'll cover what a dividend actually is, when you can and can't pay one, and the basic mechanics to get it right. Firstly then, what is a dividend? Gov.uk defines a dividend as a payment a company can make to shareholders if it has made a profit. The key parts to draw out are firstly shareholders, the owners of the company. That's different from directors who run the company and aren't entitled to dividends. The final part is also key. Dividends can only be paid from profits, so after paying corporation tax, not from revenue or from cash in the bank. That's where most confusion comes from. So if the company makes a profit, pays corporation tax, then what's left over can potentially be distributed as dividends. It can come from retained profits, which are accumulated profits over time. This means dividend could potentially be paid even if the company made no profit in a particular year, as long as it has retained profits from previous years. Equally, a company might have significant cash in its bank account but not be profitable and therefore can't pay a dividend. If a dividend is paid without there being enough profit, then this is treated as something called an illegal dividend. In practice, that usually means it will get reclassified, often as a director's loan, which can create additional tax implications if not dealt with correctly. Let's look at an example then. Company A has £50,000 sitting in the bank, but it hasn't made any profits. Maybe it's been funded by a loan or by refinancing. So even though there's cash in there, there are no retained profits. Therefore, the company A cannot pay a dividend. Now, company B only has £10,000 in the bank, but it has £30,000 of retained profits built over time. That company can pay a dividend even though it has less cash. So the key point is this: it's not so much how much cash there is in the bank, it's whether there are profits available to be distributed. How much you take as dividend is a more personal decision and depends on your wider tax position. That includes things like your other income, how much you've already taken in the year, and whether and which tax band you fall into. From a UK perspective, there is a small dividend allowance, which is currently £500 per year. Dividends up to £500 are taxed at 0%, and beyond this, dividends are taxed depending on your income band. You're looking at 8.75% within the basic rate band, 33.75% in a higher rate band, and up to 39.35% at additional rate. The more income you have, the higher the rate you'll pay on the dividends. Reasons that dividends are often used by owner-managed businesses because even with those rates, they're typically lower than income tax rates, and there's also no national insurance to pay on dividends. So therefore, they form an important part of how profits are extracted from a company tax efficiently. One thing to be aware of is that dividends are paid based on shareholding. So if there's multiple shareholders, dividends have to be paid in proportion to those shareholdings. That can make planning more difficult, particularly if there are different shareholders have different income needs or tax positions. The key point is this though, there isn't a one-size-fits-all number. We'll move on now to the mechanics of how you actually pay dividends. The process itself is fairly straightforward, but it needs to be followed properly. Step one is to check you have sufficient retained profits in the company to pay a dividend. That's the key decision point and it's worth confirming with your accountant. Step two then is to declare the dividend. This requires a board meeting, minutes to produce, and a dividend voucher. A dividend voucher is a tax record for the shareholder to support their personal tax return. The final step then, number three, is for the dividend to actually be paid out, usually by a bank transfer from the company. It can also be added to the director's loan account for future withdrawal, depending on the position of the director shareholder. To summarise then, dividends are a distribution of profits to shareholders. They can only be paid when there's sufficient retained profits available to do so. And if you're basing it just on how much cash is in the bank, you're probably doing something wrong. So make sure you speak to your accountant. Hope you found this video useful. If so, you're going to love this next one where I talk about ways that business owners can tax efficiently extract money from their company to buy investment property with. Watch the video now.